Introduction. The silver earthquake. Silver just dropped 4.7% in one session. Screens are red, headlines are screaming crash, and most people think the story is over. But what if this drop isn't the event? What if it's the setup? What if the real shift isn't happening on your price chart, but inside vaults, inside delivery notices, inside a countdown that ends in just days? COMEX inventory has crossed a line most investors don't even know exists. And when that line gets crossed, history doesn't repeat politely, it snaps. 16 days, one threshold, one market that may be tighter than anyone is admitting. And if you're only watching price, you might miss the moment that changes everything. Now, welcome to Market Metal. If you've been stacking, investing, or simply protecting what you built over decades, this channel is for you. And if you're over 50, if you've seen markets lie before, I want you with us here. Subscribe, not for hype, but for clarity when it matters most. And before we continue, tell me in the comments, where are you watching from today? Because what happens next could matter wherever you are. The delivery concentration problem. The headlines focused on price. Silver had fallen sharply in a single session. Commentators described volatility, sentiment shifts, and technical breakdowns. But serious observers were not watching the price alone. They were watching the structure beneath it. In the background of the futures market, a quiet concentration had formed. One institution, JP Morgan, had accounted for 99% of recent silver deliveries on the COMEX exchange during a critical reporting window. That number did not reflect opinion. It came directly from exchange-issued delivery reports. For casual investors, the figure meant little. For professionals, it meant everything. They understood that delivery is not symbolic. It is the final stage of a futures contract when paper claims convert into physical metal. In normal conditions, delivery volume is distributed among several clearing members. Risk spreads across institutions. No single node carries the operational weight of the entire system. That distribution is part of what gives a futures market resilience. When one institution dominates delivery issuance at a 99% level, resilience becomes concentration. And concentration introduces fragility. At the same time, another metric crossed a psychological and structural threshold. Registered silver inventory on COMEX fell below 100 million ounces. To understand why that matters, one must understand the difference between eligible and registered metal. Eligible silver is metal stored in approved vaults but not designated for delivery against futures contracts. Registered silver, by contrast, is specifically allocated and ready to fulfill delivery obligations. Only registered metal counts when a contract holder stands for physical delivery. In October 2025, registered inventory stood near 167 million ounces. Within months, it declined by roughly 40%. By early 2026, the total hovered around the 100 million ounce mark. That is not a small move. That is a material structural contraction. Business leaders who follow commodity markets understand a simple rule: inventory compression changes behavior. When inventories shrink, optionality shrinks. When optionality shrinks, pricing power eventually shifts. But markets do not react immediately. First comes denial, then rationalization. Only later comes recognition. The deeper concern is not merely the size of the inventory, it is the relationship between inventory and open interest. Open interest represents the total number of active futures contracts. Each contract represents a claim, either for financial settlement or, in certain cases, for physical delivery. Historically, only a small percentage of contracts proceed to physical settlement. Many are rolled forward or closed before expiration. This structure allows futures markets to function efficiently without requiring full physical backing of all outstanding contracts. However, when delivery rates begin to rise above historical norms, inventory thresholds become critical. A market that relies on low delivery participation becomes vulnerable if participants change behavior. The concentration of 99% delivery issuance by one bank raises a structural question. Why is one entity absorbing almost the entire delivery function? Is it a temporary liquidity adjustment, or is it a signal that others are stepping back? Decision makers in the business community know that supply chains fail at points of concentration. In logistics, if one port handles most national imports, disruption at that port creates systemic stress. In finance, if one institution carries disproportionate exposure, that institution becomes a single point of failure. The silver market is no different. Registered inventory below 100 million ounces is not catastrophic on its own, but thresholds influence psychology. Risk managers build models around round figures. Traders set alerts, funds adjust exposure. The crossing of such a level triggers attention inside institutions long before it becomes a public narrative. For young entrepreneurs observing this dynamic, the lesson extends beyond silver. Markets operate on layered systems. The visible layer is price. The structural layer is inventory, leverage, and concentration. The structural layer determines outcomes. When a single institution controls nearly all delivery issuance, it means the plumbing of the market is centralized. Centralization reduces redundancy. Redundancy is what prevents systemic shocks. This does not mean collapse is imminent. It means stress tolerance declines. Commodity history offers parallels. In 1980, extreme delivery pressure in precious metals forced exchanges to alter rules and margin requirements. In 2008, commodity inventories fell sharply during financial crisis conditions, triggering supply chain disruptions. In each case, the visible price action was secondary to structural mechanics. Serious observers are asking a narrow but important question. If registered inventory continues to decline at the current pace, and if delivery participation remains elevated, who ultimately bears the delivery burden? If it remains concentrated in one institution, the market becomes dependent on that institution's balance sheet strength and operational capacity. If that institution reduces participation, delivery spreads must rebalance quickly, or volatility follows. For entrepreneurs building companies in manufacturing, technology, or renewable energy, this dynamic matters. Silver is not only a monetary metal, it is an industrial input. Solar panels, semiconductors, electric vehicles, and advanced electronics rely on it. Inventory stress in futures markets can precede procurement stress in physical supply chains. The business community has learned this lesson repeatedly in recent years. Tight inventories lead to sudden price repricing. Repricing leads to cost uncertainty. Cost uncertainty disrupts planning. Thus, the real issue is not whether silver fell 4% in one session. The real issue is whether inventory compression combined with delivery concentration signals a structural shift. They observe three converging elements. First, a sharp decline in registered inventory. Second, an unusually high delivery concentration in a single institution. Third, elevated attention around delivery windows approaching in the near term. None of these elements alone prove systemic stress. Together, they create a pattern. Markets rarely announce transitions clearly. Structural shifts begin quietly. They appear in data tables before headlines. They surface in clearing reports before price spikes. The question facing serious observers is simple. Is the silver market experiencing a temporary liquidity fluctuation, or is it approaching a structural imbalance that will force repricing? In business, waiting for headlines often means reacting late. Strategic advantage comes from understanding the mechanics before sentiment shifts. Registered inventory below 100 million ounces is a data point. 99% delivery concentration is another. Individually, they are numbers. Combined, they form a warning signal. Not of immediate collapse, not of guaranteed crisis, but of tightening margins within a system that depends on confidence and smooth delivery processes. When confidence erodes, price follows, and those who understand structure before sentiment often position themselves accordingly. Part 1 ends with a disciplined question rather than a prediction. If delivery remains concentrated and inventories continue to contract, how resilient is the system beneath the price chart? That is the issue decision makers must examine, calmly, analytically, and before the broader market begins asking the same question. Paper claims versus physical reality. The structural leverage beneath the silver market. They were not watching price anymore. The serious observers had shifted their attention to something quieter, something more structural. They were studying the relationship between open interest and deliverable metal, and the numbers were no longer comfortable. Open interest in the March silver contract represented hundreds of millions of ounces in paper claims. Registered inventory, the metal officially available to satisfy delivery, sat just above or slightly below 100 million ounces, depending on the day's report. On the surface, this mismatch was not new. Futures markets are designed with leverage embedded in them. A single ounce of physical metal can support multiple paper contracts, because historically, very few contract holders demand delivery. The system functions on probability, not full backing. But probability changes when behavior changes. For decades, delivery participation typically hovered between 2% and 5% of total open interest. That statistic became a structural assumption. Risk models were built around it, margin requirements reflected it, clearing members operated comfortably within it. Then February arrived. Delivery participation surged to levels rarely seen in modern silver trading. Instead of a small percentage standing for delivery, the rate climbed dramatically, approaching levels that forced institutional desks to take notice. It was not panic, it was calculation. When delivery participation increases materially, the futures market begins to transform. It shifts from being primarily a financial instrument into a physical allocation mechanism. Contracts are no longer simply tools for hedging price. They become pathways to secure actual metal. That shift matters, because the futures market is built on leverage, not full physical equivalence. It works smoothly when most participants prefer cash settlement or rolling positions forward. It tightens when participants demand physical certainty. The structural tension lies in this question. What happens if elevated delivery rates persist? At current open interest levels, even a modest increase in delivery participation could absorb a significant portion of registered inventory. If participation reached 20% or 25%, the volume demanded would approach or exceed available deliverable supply. In past cycles, the exchange relied on normal behavioral patterns to manage this risk. But markets are adaptive. Participants change behavior when they perceive future scarcity. Some institutional desks had already begun adjusting models. They were not forecasting collapse. They were stress testing scenarios. They asked 3 structured questions. What if delivery participation continues above historical averages? What if inventory declines further before the March window closes? What if concentration in delivery issuance remains centralized? None of these scenarios guaranteed disruption, but each reduced system flexibility. There are mechanisms available to absorb strain. Contracts can be rolled forward. Cash settlement can increase. Margin requirements can be adjusted to cool participation. These tools have worked before, but each mechanism carries a signal. Rolling contracts implies participants prefer optionality. Elevated cash settlement implies participants prefer liquidity over metal. Increased margin requirements imply the exchange is dampening leverage. The deeper concern arises when participants prefer physical over optionality. Why would they? Industrial consumers may prefer guaranteed supply for manufacturing schedules. Sovereign-aligned entities may seek strategic stockpiles. Institutional funds may view inventory compression as a forward pricing indicator. When demand for certainty rises, paper leverage becomes more fragile. Entrepreneurs watching this pattern should recognize the principle immediately. It is the same dynamic that appears in business inventory cycles. When inventory buffers shrink and demand remains stable, the pricing environment changes. But the futures market introduces another layer, leverage. A single futures contract represents 5,000 ounces of silver. Multiplied across tens of thousands of contracts, open interest represents a theoretical claim far larger than registered stock. Again, this is normal until behavior shifts. Recent data suggested that market participants were no longer behaving strictly within historical norms. Elevated delivery percentages in the February contract forced clearing members to adjust risk exposure. That adjustment is rarely visible in headlines. It appears in clearing flows, collateral allocation, and warehouse reports. Business leaders who operate in leveraged environments, real estate, venture capital, commodities, private equity, understand that leverage magnifies both efficiency and vulnerability. The silver futures market is no exception. The suspense does not come from a sudden price spike. It comes from quiet compression, from watching ratios narrow, from observing the system operate closer to its tolerance threshold. They understood something subtle. Markets rarely fail abruptly without warning. They strain first. They signal imbalance through data before they express it through price. Open interest to registered inventory ratios approaching 4-to-1 or higher are manageable when delivery participation is low. They become sensitive when participation rises. And delivery participation had risen. This was not a retail phenomenon. Retail traders rarely stand for delivery of 5,000-ounce contracts. The entities participating at scale were institutional. Institutions do not act impulsively. They act strategically. If institutions begin converting paper exposure into physical allocation at elevated rates, they are expressing preference for certainty over leverage. That preference is a structural vote. The exchange has tools to maintain order. It can expand eligible conversion, encourage roll activity, or adjust margin structures. These interventions can stabilize short-term strain, but each intervention narrows optionality further. The question now confronting serious observers was not whether silver would rally tomorrow. It was whether the structural leverage embedded in the system could absorb another elevated delivery cycle without visible stress. For young entrepreneurs building in volatile sectors, this offers a lesson beyond commodities. Leverage works when confidence is stable. It compresses when participants seek certainty. When too many participants seek certainty at once, leverage must contract. Contracting leverage is rarely quiet. The coming delivery window would serve as a stress test, not only of inventory levels, but of behavioral patterns. If delivery participation returned to historical norms, the system would breathe easier. If it remained elevated, inventory would compress further. And if inventory compressed further while concentration persisted, the margin for flexibility would narrow sharply. Markets can operate under strain, but strain accumulates. Part 2 leaves decision makers with a precise structural question. If behavior has shifted from financial settlement toward physical allocation, is the futures framework prepared to absorb sustained demand for delivery? That answer will not be found in daily price charts. It will be found in warehouse reports, clearing flows, and participation data, where the real story is unfolding quietly beneath the surface. The global divergence. Why the East and West are sending different signals. While Western screens showed falling prices, something very different was happening across the Pacific. Serious observers had learned to watch not just New York, but Shanghai. Not just futures, but physical markets. Because when paper and physical begin to tell different stories, the divergence often precedes resolution. In recent sessions, Shanghai silver was trading at a measurable premium to Western spot prices. At certain moments during the decline, that premium widened sharply. Even after accounting for value-added tax, the effective wholesale price in China stood materially above the quoted futures price in New York. That gap was not random. Premiums in physical markets serve as signals. They represent willingness to pay above quoted benchmark prices in order to secure immediate delivery. When premiums expand, they indicate tightness, not speculation. If Western futures were accurately reflecting supply and demand, premiums should compress during price declines. Instead, they held firm. This is where the narrative becomes more complex and more strategic. China had recently adjusted its silver export framework. Silver was categorized under more restrictive channels, limiting export activity to approved entities. That reclassification placed silver alongside materials considered strategically sensitive. Observers did not interpret this as a short-term trade adjustment. They interpreted it as policy alignment. When a nation labels a material as strategic, it signals long-term positioning. It suggests planning beyond quarterly volatility. It implies preparation, not reaction. Meanwhile, warehouse inventories in Asia were not expanding. They were stable to declining. Industrial demand in the region, driven by solar manufacturing, electronics production, and electric vehicle infrastructure, remained structurally strong. The divergence became harder to ignore. Western markets were pricing short-term sentiment shifts. Eastern markets were paying premiums for immediate physical access. For business leaders, this divergence raises a strategic question. Which signal carries more weight, financial pricing or physical behavior? Institutional flows added another layer. Exchange-traded vehicles tracking silver reported significant inflows during the price weakness. That behavior contradicted retail panic narratives. It suggested accumulation during volatility rather than distribution. Institutional capital often moves quietly. It rarely announces conviction publicly. Instead, it expresses conviction through allocation. Large inflows during declining price environments are rarely coincidence. They reflect forward-looking positioning. At the same time, silver lease rates, an often overlooked metric, had risen sharply from historically low levels. Lease rates represent the cost to borrow physical metal. When they rise, it indicates that holders of metal are less willing to lend or that borrowers are competing for available supply. Elevated lease rates rarely appear in speculative bubbles. They appear in tightening markets. Industrial demand dynamics reinforce the picture. Over half of annual silver supply feeds industrial consumption. Unlike speculative demand, industrial demand is less sensitive to short-term price movement. Production lines continue operating, contracts continue being fulfilled, and silver supply remains constrained by structural realities. A significant portion of global silver production is a byproduct of mining for other metals such as copper, lead, and zinc. That means silver output cannot easily increase in response to price signals. It is tethered to unrelated production cycles. When supply is inelastic and demand remains stable or rising, inventory compression becomes meaningful. The east-west divergence thus becomes more than a regional pricing anomaly. It becomes a structural indicator. Western futures markets operate heavily on financial flows, margin requirements, and macroeconomic expectations. Eastern physical markets operate on procurement, manufacturing schedules, and strategic stockpiling. If Western price weakness fails to suppress Eastern physical premiums, the imbalance persists. History shows that when paper pricing diverges from physical scarcity for extended periods, convergence eventually occurs. The direction of convergence is rarely ambiguous. The suspense lies in timing. Will physical premiums compress toward paper prices, or will paper prices adjust toward physical premiums? Business decision makers do not speculate on ideology. They study incentives. Eastern policy adjustments indicate incentive to secure supply. Institutional inflows during weakness indicate incentive to accumulate. Elevated lease rates indicate reluctance to part with physical holdings. These are not emotional signals, they are structural signals. For entrepreneurs operating in supply-sensitive industries, this divergence carries operational implications. If procurement becomes tighter globally, cost structures adjust. If cost structures adjust, pricing power redistributes. The silver market thus becomes a case study in global commodity flow dynamics. Western financial markets may reflect short-term monetary narratives. Eastern physical markets often reflect long-term strategic resource planning. When those narratives diverge, the question becomes which market will dictate eventual equilibrium. Part 3 leaves the audience with a sharpened perspective. If one region is paying premiums to secure metal while another region prices decline on futures exchanges, the divergence cannot persist indefinitely. Either physical demand weakens or financial pricing realigns. Serious observers are watching warehouse flows, export policies, and lease rates more closely than daily price candles. Because beneath volatility, something larger may be unfolding. a structural repositioning of silver as both industrial input and strategic asset. And when structural repositioning occurs, it rarely announces itself with noise. It reveals itself through divergence first. Resolution comes later. The delivery window where structure meets reality. Every futures market contains a moment of truth. In silver, that moment arrives on first notice day. February 27th is not dramatic in itself. It is procedural. It marks the beginning of the formal process, where holders of long contracts notify the exchange if they intend to take delivery of physical metal. After that notice, the exchange and its clearing members must fulfill those obligations within the contractual framework. Under normal conditions, very few contracts proceed to delivery. Most participants close positions or roll forward into future months. The system functions because physical settlement remains limited, but this month does not exist in isolation. Registered inventory sits near 100 million ounces. Open interest for the March contract represents several multiples of that figure. Delivery participation in the previous contract cycle exceeded historical norms. That combination transforms a routine calendar event into a structural checkpoint. Serious analysts are not asking whether every contract will demand metal. They are modeling scenarios. If 5% of open interest stands for delivery, the exchange operates comfortably. That is historical precedent. If 15% stands, inventory compresses materially, but remains manageable. If 25% stands, the margin tightens sharply. Above that threshold, flexibility narrows quickly. The system has tools. It can encourage rolling. It can expand cash settlement incentives. It can adjust margin requirements. It can facilitate conversion between eligible and registered categories. But tools are not infinite. The suspense does not lie in collapse. It lies in tolerance. Markets can absorb stress until they cannot. The breaking point is rarely announced in advance. It emerges when thresholds intersect. This time, several thresholds are intersecting simultaneously. Registered inventory has contracted significantly in recent months. Delivery participation has elevated beyond long-term averages. Lease rates have risen, indicating reluctance to lend physical metal. Global physical premiums have persisted despite price weakness. Institutional inflows have occurred during volatility. None of these factors independently guarantees disruption. Together, they create a tightening lattice of constraints. Entrepreneurs understand this pattern intuitively. It mirrors supply chain compression. When warehouse stock declines, suppliers tighten terms. When suppliers tighten terms, buyers seek certainty. When buyers seek certainty simultaneously, strain multiplies. In leveraged markets, strain expresses itself through repricing. But repricing is not always immediate. Sometimes the system stabilizes through coordination. Sometimes participation falls back to normal levels. Sometimes stress dissipates quietly. The coming delivery window will test which outcome prevails. Overlaying this structural checkpoint is a macroeconomic catalyst, inflation data, and monetary policy expectations. If inflation surprises to the upside, the dollar may strengthen. Higher rate expectations could pressure commodity prices temporarily. That scenario might dampen speculative demand in the short term. If inflation cools and labor markets soften, rate expectations could adjust downward. That would reduce dollar strength and potentially support metals. But macro catalysts influence sentiment. Delivery windows influence structure. Sentiment moves quickly. Structure moves slowly until it shifts suddenly. Business leaders must differentiate between the two. They observe that volatility has cleansed leveraged long positions. Open interest has declined from recent peaks. Weak hands have exited. This matters. Major repricing events in commodity markets rarely occur at euphoric highs. They often occur after sentiment has deteriorated and leverage has been reduced. Structural shifts tend to emerge when attention fades. The quiet before a move is often mistaken for resolution. The delivery window thus becomes more than a calendar date. It becomes a stress test of confidence. If delivery participation reverts to historical norms, the system breathes easier. Inventory declines slow. Concentration risk disperses. The narrative resets. If participation remains elevated or accelerates, inventory compresses further. Concentration risk intensifies. Flexibility declines. The exchange would then face a series of tactical choices. Facilitate cash settlement expansion, encourage voluntary rolling through pricing incentives, or adjust rules to stabilize participation. Each choice carries signaling effects. Cash settlement at scale signals preference for liquidity over metal. Margin hikes signal an attempt to dampen behavior. Rule changes signal adaptive intervention. Markets interpret signals. For young entrepreneurs and business operators, the silver market offers a broader lesson in system design. Leverage amplifies efficiency but reduces tolerance for synchronized demand. Concentration reduces redundancy. Inventory compression reduces optionality. When all three align, resilience depends on behavioral moderation. The coming weeks will reveal whether behavior moderates or intensifies. This is not a prediction of crisis. It is a recognition of proximity to structural thresholds. Commodity markets have endured stress before. They have adapted. But adaptation is not frictionless. It carries cost, often in price volatility. The final suspense is not whether silver rises or falls in the short term. It is whether the structural relationship between paper claims and physical supply remains stable under delivery pressure. If stability holds, volatility subsides. If stability wavers, repricing accelerates. Decision makers who rely on silver, whether as investors, manufacturers, or strategic planners, must monitor more than daily candles. They must monitor warehouse flows, delivery notices, lease rates, and participation ratios. Because by the time headlines declare a shift, the structural move will already have occurred. The delivery window is approaching, not as spectacle, as examination. And examinations reveal what pressure hides. The question now is simple, and it carries weight far beyond a single metal. When structure meets reality, which side adjusts first, paper claims or physical supply? The answer will define not only this cycle, but the credibility of the system itself.